Welcome to the Build Wealth Canada Show, episode number 59.
Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
All right, welcome to the show. Before I introduce the guest, I wanted to let you know that I'll be speaking again at the Canadian Financial Summit next week, and I have free tickets for you. So the entire event, it's online, so you can watch it from anywhere, and it's Canada's largest personal finance conference. I'll be there together with over 25 Canadian personal finance experts, and in my talk, I'll be speaking about how we optimized our investment portfolio before we retired and after we retired. So no matter where you are on your financial independence journey, it'll at the very least give you some insights on ways that you can optimize your own investment portfolio so that you can retire early or at least hit your financial independence number quicker so that you can actually do whatever it is that you want in life. So to get your free tickets for a limited time, just go to buildwealthcanada.ca/conference. That's buildwealthcanada.ca/conference. And if you're listening to this episode months or years after the conference is already over, then you can still go to that link to sign up and be informed when I have free tickets for next year's conference. And also as a bonus, I'll also email you a recording of my talk from this year's conference so that you don't miss it. So that link again is buildwealthcanada.ca/conference. Definitely sign up. It's totally free. It has many of the top personal finance experts in Canada, and I hope to see you there. All right, let's get into our guest for today, which is Jason Heath. Jason has been providing fee-only, advice-only financial planning since 2001 and is one of Canada's best-known fee-only financial planners. He is currently a personal finance columnist for the Financial Post and MoneySense magazine. He is also a regular contributor to RetireHappy.ca. Now, I've been reading his insightful financial planning articles on MoneySense for years now, and I've definitely become a fan of his writing and insights over that time. So I thought it would be great to have him on the show to discuss how we Canadians can optimize our investment portfolios both before retirement, when we're in the growth phase trying to retire early, and after retirement once we've hit our number, just to make sure that we don't actually run out of money once we're there. Now, as usual, I want to give a big thanks to EQ Bank for sponsoring the show. I'm definitely still offering out my guide for free on the top ETFs in Canada for anybody that opens up a free account with them using my link, and I'll be offering this pretty much indefinitely, and I'll be updating the guide every single year. So even if you're listening to this years from now, you can still sign up and I will give you the latest guide for that particular year. Now, I've been using them for 4 years, even before they became a sponsor of the show. And the main reason is that they have one of the highest interest savings rates in Canada. They are currently offering 2.3%, which is more than double what the major banks are offering. It's also free to sign up and keep an account with them, so you're not paying a monthly fee like you do with many of the other banks out there. And you also get unlimited transactions, unlimited Interac e-transfers, and you can take out your money at any time if you need it. There's no minimum balances or anything like that. And so because of those reasons, I've been with them ever since they launched in Canada years ago, and it's where I keep my entire emergency fund and spending money as well, and pretty much the safety portion of my portfolio. So basically, just about everything of mine that isn't being invested in ETFs goes directly into my EQ Bank account to earn me that high interest. So to get the free high interest account and the free guide on the top ETFs in Canada, just go to buildwealthcanada.ca/EQ. That's buildwealthcanada.ca/ the letter E and the letter Q. Open the free account, and once you're done, forward any email that you get from EQ to bonus@buildwealthcanada.ca, and I'll send you the full comprehensive guide for free. So that link again is buildwealthcanada.ca/EQ to open an account, then forward me any email from EQ to bonus@buildwealthcanada.ca. and I'll email you the free in-depth guide. You do have to use that link, that buildwealthcanada.ca/EQ link, in order to get the bonus. All right, so enjoy. Thank you so much for supporting that show in that way. A lot of people already have, so I really do appreciate you guys, supporting me and helping me so I can keep producing these episodes and bring on really high quality guests. So I really do appreciate for everyone that has done that already for me for the show, and I definitely am making a really strong effort to make it worth your while by really producing some really high quality episodes with some really high quality guests so that you can optimize your finances and your investments even further. So thank you so much. Thank you for supporting the show. And now let's get into the episode. All right, Jason, welcome to the show.
Thanks for having me, Cornell.
So Jason, to kick things off, what do you think is the best way for do-it-yourself investors to determine their asset allocation in terms of what percentage of stocks versus fixed income to hold in their portfolio?
Yeah, it's a loaded question, and I wish there was a nice, simple, clean answer. I think a lot of financial questions and financial planning challenges, it would be nice if there was just a simple answer, but I think this is one where it's more art than science, I suppose. There are rules of thumb out there that people may be aware of, certainly 100 minus your age for figuring out your allocation to stocks, so that a 30-year-old, for example, would have 100 minus 30 or 70% of their portfolio in stocks versus an 80-year-old would have 100 minus 80 or 20% in stocks. I mean, that concept makes sense, I suppose, in theory, but it's not always appropriate. I tend to look more to risk tolerance assessments. You can have a 30-year-old who has a very low risk tolerance, who may be all in GICs, or maybe they're saving towards a home down payment in a couple of years and their time frame for the money is really short. So despite being young, it wouldn't make sense to have a high exposure to stocks. And look, I have clients that are in their 80s who are 100% in stocks because they're living off the dividend income. They have a high risk tolerance. They're well-versed investors. So it's hard to give a one-size-fits-all answer. And I think one of the other challenges is it may differ by account. Your overall asset allocation might be a certain percentage in risky assets like stocks and a certain percentage in fixed income. But when you're looking to optimize tax efficiency and depending where you're going to take withdrawals from, you may have all equity in one account and all fixed income in another. So it makes certainly asset allocation for any investor, particularly DIY investors, challenging.
Mm-hmm. Now, does that answer change at all in terms of your process? So when you have a new client come on, for example, does your process of figuring that out change depending on whether, let's say, they are working towards, let's say, an early retirement versus already being retired?
It can, certainly. I think the earlier that somebody is looking to retire or has retired, obviously the longer their time frame and their retirement is likely to be. And absent a pretty significant amount of investment capital, an early retiree may need to have that much more stock or risky asset exposure within their portfolio. There's certainly a correlation between the amount of money you have in stocks and your expected long-term rate of return. So if you need your money to last a long time and you want your money to outlast you, having a high exposure to stocks is really important. But like I said, you can have an 80-year-old who has a 100% stock exposure because they're not really dipping into the capital, and the risk tolerance is good. So it makes it really difficult. I see people that are at opposite ends of the extreme, and I think that investing and asset allocation are very personal strategies.
Mm-hmm. So it sounds like your process is, let's say you bring on a new client, that yes, you have them do those risk questionnaires, right? Those asset allocation questionnaires.
Sure, yeah,
trying to determine the risk.
They can be helpful for sure.
Yeah. So I guess you do that, but it sounds like you sit down with them, you meet with them, and you talk, and you really try to find out their entire financial situation, both where they sit psychologically, but also where they are sort of in their life in terms of investments and assets and all that. And then it sounds like you put all that together and say, okay, the questionnaire as answers is this, but because you've answered this particular way to these questions and because of this situation, let's maybe tweak it a bit more conservative towards fixed income or a bit more aggressive towards equities. Does that sound right?
Absolutely. I'll tell you, I tested out a risk tolerance questionnaire that we were using a few years ago. I answered it myself, and I felt as if I gave the most aggressive answers that could have been given. Maybe I didn't, and I was surprised when the recommended asset allocation came back for me. And I can't remember specifically. I think it recommended somewhere between 70 and 80% in stocks. I'm 40 years old right now. And for perspective, my children, my oldest child is 11 years old, so going to university in 7 years. And I've got 100% stock allocation in his registered education savings plan because I'm fairly confident that 7 years from now, stocks will be higher. But even me, when I looked at my own responses to the risk tolerance assessment, I took them with a grain of salt. And I think that you need to do that with even the scientific process of doing those types of questionnaires.
Mm-hmm, for sure. I hear you. I find it's like I've done them myself as well, and it's you're kind of at the mercy of their algorithm a little bit, right? And you might not always agree with the way that their algorithm is set up. So I see what you're saying, because one may say, oh, well, they put a really high weight towards your age. So it's like, oh, you're this age, so you must be really high. We must put you really high into fixed.
Or you're self-employed, for example, like I am, and
right.
Risk is in your business, so you should be more conservative in your investments. So
that's right.
They're imperfect, but certainly it's better than nothing. And I can tell you that I've worked with clients where they say, oh, I'm not a very aggressive investor. I'm pretty conservative. And you sit down and you look at their investment portfolio and they're like 80% in stocks.
Right.
And they may not even realize. Yeah, oftentimes you ask somebody, how much do you have in stocks? How much do you have in bonds? Not sure. How do you pay your investment advisor? How do you pay your fees? Not sure. It's amazing how few people realize what they're invested in, what fees they're paying, things like that. And again, these asset allocation questionnaires at least provide some perspective to having an intelligent discussion with a client about their investments.
For sure. I find too that people's emotions and feelings about the answers can really change depending on when you ask them and how you ask them. And then also I find too, the biggest surprise to me was it really impacts how much they already know about investing. So I noticed I've done a whole bunch of these. I know Vanguard has a good one. I can leave that. I'll put a link to that in the show notes. It's a free question people can take. But I remember doing a bunch of them. And yeah, sometimes they ask you these questions. And if you know sort of the history of the stock market and how indexes tend to perform and things like that, then your answers are going to be vastly different to somebody that views the stock market as this extremely risky thing where it's like all or nothing, like a stock picker or like a day trader's kind of perspective, right? So I find depending how much education you have and where your head's at, it can really, really impact. Just an hour of education could totally change your asset allocation when you do these questionnaires, I find.
But the irony of questions like that and assuming that people who know more about investing or have more experience are going to have a higher risk tolerance is, I remember, I wish I could remember which university it was. It might have been Stanford. It was one of the big U.S. schools had done this study, and they had obtained a number of years of data from a discount brokerage in the U.S., and it looked at do-it-yourself investors and their long-term investment performance and compared it to, the biggest pension plans and mutual funds in the United States. And one of the things that the particular study found, I believe the time period was somewhere in the 80s and the 90s and in sometime after 2000, they actually found that market timing and long-term investment performance for do-it-yourself investors in that particular study, that the better market timers who avoided selling low and buying high were the do-it-yourself investors, and that the professionals did a very poor job of market timing. And one of the hypotheses that they put forward is that the do-it-yourself investors, many of whom did not transact on their accounts at all, they just bought and they sort of forgot about their investments. One of the reasons that they did not become susceptible to selling low and buying high and making investment mistakes is because they weren't paying attention,
right? And
they were not as well versed. And their complacency actually led them to be better market timers. So it's amazing that sometimes knowing less and paying less attention can be a good thing.
Mm-hmm, mm-hmm. Yeah, that's really interesting. I remember seeing or hearing about some other study that a company did where they looked at, okay, well, which of our investors are doing better and which ones are doing worse, and they found this like really, really small segment of their customers that were doing surprisingly better than all the other ones. And then they tried to find out what they had in common, and then the answer was that they were all dead.
Oh, there you go.
So they were passive to the extreme in the sense that they can't really,
Awesome.
do anything, right? So they kind of, I don't know how they, maybe they were going through the transitioning to their like spouse or something. I don't know what the details of it was, but
it goes to show you.
But it just goes to show you.
Portfolio, especially for a do-it-yourself investor, too much tinkering can be a bad thing.
For sure. Yeah. And to your point, I mean, I'm looking at the living people. I think, if they are not trying to time the market, they might just say, I mean, this is what we did when we were, saving for retirement is we just said, okay, with every paycheck, okay, we're going to put this amount in. And it became this very, you're just dollar cost averaging in.
Just
it becomes
buy every Friday or every other Friday.
Exactly. Every paycheck you put this in and it's a consistent amount and you don't try to time it. You just do it. And I mean, I think there's so much evidence at this point too, right? That says that market timing is really, I mean, no one can really do it consistently, right? I have yet to see some reputable study that says, oh yeah, there's, these perfect market timers in the world. I have yet to, to see one. So I totally see your point. Now, for somebody that's approaching an early retirement or even a traditional retirement, do you also base the percentage of their fixed income on some sort of spending related rule? So for example, that common advice to hold 5 years of living expenses as fixed income, as that should ride out most recessions if we're looking at historical data?
I don't necessarily. I mean, I have some clients that like to take a bucketing approach like that, where they might have 3 or 5 years or whatever the case may be in cash or near cash or fixed income. And beyond that, they have stock exposure. I think one of the challenges with bucketing goes back to that market timing discussion we were just having, that it sort of purports that when stock markets are down, that people are going to draw down on their cash and their fixed income instead, and then they're going to somehow flip the switch and move back to their stocks when markets rise. And I think one of the challenges with timing the market is you need to be right twice. You need to pick the right time to sell. You need to pick the right time to buy. And even the experts have a tough time being right once. There's been studies that have shown that compared to just maintaining a constant asset allocation and drawing down proportionately from your portfolio, that bucketing and trying to draw down on cash in down markets does not necessarily perform better, that you might be better off just maintaining a constant asset allocation with your investments. And I kind of like that because maintaining a similar asset allocation, regardless of the market conditions, kind of forces you to do what you want to do as an investor. You want to sell high and buy low. And if you're taking a withdrawal from your portfolio at a time when markets are high, you're going to end up taking more money from stocks. And if it's when stocks are down, you're going to take more from bonds. And I think it reinforces the best possible investor behavior without adding any emotion to it. So although I'm not a big fan of a bucket strategy, my own approach is that there is no one size fits all answer, and you just need to talk things through with clients. And if having things bucketed, having a year or 3 years or 5 years of expenses or withdrawals in cash or fixed income makes sense for them, then, so be it. And you have to try to work with them accordingly.
So it sounds like with your clients, your practice in general, so do you guys do more of sort of you just look at the sort of total, you look at the portfolio as one whole and you just do a total return approach and you say, we're just going to keep at this allocation?
Absolutely.
Okay.
That's my own bias. But again, I have clients. I can think of one that I met with recently that is very specific in the terms of the bucketing that they do, down to this is the vacation bucket, this is the bucket for this is the bucket for that, and literally have it broken into separate accounts. So I try to take the same approach with any types of financial discussion that I'm having with clients, even as it relates to investment strategy. Some of my clients are do-it-yourself investors. Some of my clients are stock traders. Some of them are passive investors. Some work with investment advisors who are discretionary portfolio managers or stockbrokers, and yet others have all their investments in rental real estate. So I think it's very important, particularly in my line of business, to be open-minded that not everyone is going to want to invest their money, build their portfolio, and take their withdrawals and retirement in the same way. It's kind of like, pizza. I mean, I think that it is immoral to put pineapple on pizza. I love pineapple. I think it is very wrong to put fruit on a pizza. My wife does it once in a while, and I cringe and look the other way. But everyone's a little bit different, and you have to try to work with them on that basis is my own approach.
Mm-hmm. So is your default, in a way, it sounds like you'll just say, okay, we'll figure out the asset allocation, what it is, and then let's say somebody's in retirement, and let's say they need, $40,000, they want that much income. So we'll say, okay, we'll take that out. Well, basically, we'll rebalance in such a way that we take that 40 out, and once we take that 40 out, you're also now rebalancing the asset allocation that you want to be, or that we want you to be at.
Yeah, and the other kind of tricky thing about the way that I myself approach portfolio management and withdrawals and retirement is that I feel that you should have your overall portfolio asset allocation, and then you need to look at it on an account by account basis. Mm-hmm. Much easier, if everything was just in an RSP or whatever, you could just a single account, it would be quite easy. But these days, with the introduction of tax-free savings account 10 years ago, most people have at least two different buckets in terms of account types they're taking withdrawals from, RSPs and TFSAs. Some have non-registered accounts. Some have, corporate accounts. We have a lot of clients who are incorporated. And you may well have 100% equity in one account, 100% fixed income in another account, and then, 50-50 in stocks and bonds in another account. And where you're taking the withdrawals from may dictate how your asset allocation is in a particular account, as well as the tax implications. So that makes it a little bit trickier, but I also don't think that, you need to be rebalancing every week or every month. I think it could be something that can happen a couple times a year.
Gotcha. Okay, no, that makes total sense. Yeah. And yeah, I totally get your point about some clients, they still want that bucket strategy. Everything I've read on that subject is that some people feel a lot more comfortable with that, just saying, okay, I have, let's say, a years of cash or 5 years of spending that I can draw on if we have another 2008, for example, and it just lets them sleep much better at night knowing that they have that. But then, like you said, it's not like that's been shown to always perform better than just doing what you guys are doing. It's just more of a psychological thing, right?
Money. Psychologically, emotionally, there's so much more at play. And oftentimes I have meetings where I think, boy, only 10% of that meeting was about money and math. The other 90% was about the mind and emotions and psychology. And if somebody feels more comfortable with a bucket strategy, great. It's kind of a similar approach. I met with a client last week who had a significant amount of cash to invest. And they said, so, what do I do? I mean, stock markets here in September 2019 are at and near all-time highs. A recession is coming. We know that. I should probably wait, right? I should probably wait and sort of ride it out and buy when markets are low. And I gave the same advice I mentioned previously. You need to be right twice. You need to pick the right time to buy, the right time to sell, whenever you're trying to time the market. And given that stocks go up about 2/3 of the time, the best time to invest a lump sum of money is today.
Right.
Dollar cost averaging into the market, if you have a lump sum of money, may feel better, but 2/3 of the time you would have been better off just doing it right off the bat. And I think if someone is going to take an approach where they're adding money into a portfolio on a regular basis, a lump sum like that, or if they need to take a withdrawal from a portfolio, if it makes them feel better to do it on a dollar cost averaging basis, then go for it. But put it into your calendar, do it monthly, do it quarterly, whatever the case may be, over whatever period of time you feel is appropriate. But literally put it in your calendar and do it that day, regardless of whether stocks are up or down or what they said on the 6 o'clock news. None of that stuff matters. Take the emotion out of your investing and your financial decisions, and ultimately I think you'll be that much better off.
For sure. Now, when you're working with clients and strategizing on what should be in that fixed income or that safe portion of their portfolio, how do you determine how much they should put into, let's say, bonds versus high interest savings account versus GICs? I mean, you mentioned you don't really use the bucket approach, but do how do you decide whether, like, do you just go, we suggest all bond, ETFs, that kind of thing, or do you do some sort of a split? Are there any certain rules or processes that you like to follow to figure this out?
I wouldn't say there's a specific rule or a specific process, but certainly the primary thing I look at is risk tolerance. That's first and foremost. The secondary thing I would look at is time horizon. You think of a young 25-year-old graduated from university, starting their first job. Conventional wisdom is they should have a very high exposure to stocks in their portfolio and very little fixed income. But a 25-year-old probably needs to get a car, needs to buy furniture to furnish, an apartment. They may be saving up for a down payment or a wedding or a child. There's so much that happens between, say, 25 and 35 that I think there's a lot of young people that should have a high exposure to cash and GICs and fixed income, despite the conventional wisdom that, you've got 40 years to retirement, you should be aggressive. So risk tolerance and time horizon to me are the most important things. And some people, I have clients these days, however pitiful the yields are. I have some clients that have a lot of money in GICs because they're simple, they're straightforward. Bonds, whether it's individual bonds or whether it's a bond mutual fund or exchange traded fund, can go down in value, and people have seen that in the last year as interest rates were starting to rise, that bonds can go down when interest rates rise. I think it really is something that needs to be personalized depending on the individual, and it's hard to come up with rules and processes. However much they sound great and they make for good sort of sound bites and news articles and things like that, I think it's something that needs to be personalized.
Mm-hmm. What are your thoughts on the bond ETFs? Like, I'm talking the broad market bonds, right? Just for the typical sort of core holding. What are your thoughts about using those versus something like a high interest savings account or a GIC, just because the yields have been so low, plus you're enduring that interest rate risk as well, right? So if you're just looking for something safe, yes, you could miss out on some of that, capital gain potentially, right? With the, if the interest rates move by, if you don't do like a bond ETF. But what are your sort of general thoughts on it? Because it seems like the yields it's not like you're getting that much more, it seems, in yield if you do a bond ETF. So I know the dilemma I've run into myself is, well, I could just do like a really high interest savings account or GIC where the rate is, it's I would say pretty comparable to what a bond ETF will dish out. But yes, there might be, if interest rates move, I may miss out on some of that, some extra gain. But that's not really the purpose of my bond portion, of my fixed income portion anyway, right? It's more of a safety play at that point. So what are your thoughts there? Because I think a lot of Canadians are struggling with this, right? They're saying, well, I'm taking on interest rate risk by doing a bond ETF. There's all these other options that have yields that are pretty, close, comparable, yeah, and it's guaranteed too, right? So that's the other big thing, right? Is I've got one thing where it's guaranteed and no interest rate risk, and the other one is not guaranteed. I may get some appreciation, but it's still probably not going to be as high as equity, or like historically, it won't be as high as equity. So, what are your thoughts on that?
Yeah, it's a very difficult time to invest in fixed income. If you're looking at exchange traded funds in particular, right now the Canada Universe Bond Index is yielding somewhere in the 2.25% range. You've got interest rate risk because the duration of a Universe Bond ETF is about 8 years. So it's not short-term bonds, it's sort of medium-term bonds, and to get 2.25% and pay a fee to do it, even if it's fairly modest, and have interest rate risk compared to GIC rates that are out there that are 2.5% plus or minus, depending on your term, and savings account rates that are fully liquid, that you can get the money the next day, that are paying higher interest rates. Again, I don't think that GICs are a bad investment right now, particularly for a do-it-yourself investor. compared to a bond exchange traded fund. It's simple, it's predictable. And I think that anybody that works with an investment advisor these days needs to have a very frank discussion with their advisor about the fixed income portion of their portfolio. If you're in GICs with an investment advisor, they're probably not getting super competitive GIC rates. If you're in government bonds and conservative corporate bonds, depending on the fees you're paying, you might be earning less than what you could earn in a GIC or a savings account. So I have clients where they have money with a discretionary portfolio manager, and they have taken the fixed income portion out and put it into GICs in some cases and just paid the portfolio manager to manage the stock portion of their portfolio. So whether you're DIY or you work with an advisor, I think it's a time to have a frank discussion about fixed income. It's tough for anyone to make money in fixed income these days. And I guess the goal is easily stated as not being to make money. It's to preserve capital. It's to provide stability with your portfolio. And we just happen to be in a low interest rate environment where you have to have low expectations, unfortunately. Mm-hmm.
Very interesting. Yeah, because I mean, I've read all this sort of traditional advice about the bonds and how important they are, the bond ETFs, for example. But then, you look at the current environment, and I've been struggling with this so much I'm trying to persuade myself to go a bit more into bonds, just to not be so equity, heavy. But I can't make a good business case out of it because of what's happening. So it's interesting. And when I talk to other professionals and they feel like yourself, I mean, they say the same thing. I hear this over and over and over again, like what you just said. So very, very interesting. And yeah, I mean, you mentioned the yield on one of the bonds. You mentioned something like 2.25%, right? So 2.25%. So I have my fixed income portion with EQ Bank, which is a high interest savings.
Oh yeah, it's 2.3, I think, now, right?
But I mean, so I mean. So if it's 2.3, then there you go. I'm beating it, and I'm beating
with no risk, with no
risk, guaranteed by CDIC, right? I mean, it's a guaranteed thing, and then so it's pretty much the same, but you're getting a guaranteed return. So I mean,
no interest rate risk, no risk of seeing your money go down if interest rates go up.
Exactly, right. So it's like, yeah. So I mean, when I see that example, I say, well, why don't I? And yes, it's still pains me to not just put that into equities, but then, I mean, it's good. You do want some fixed income portion as well, right, in your portfolios. Hey guys, just wanted to pause the interview to provide a bit more explanation on what we're talking about here. So this guaranteed interest of 2.3% makes things very interesting because when you're constructing the safety portion of your investment portfolio, the traditional advice is that you buy a low-cost bond ETF. And when you buy a bond ETF, you're basically buying a stake in hundreds or thousands of loans, and those loans pay you interest, similar to what a high-interest savings account would. Now, when Jason and I talk about yield, we're essentially talking about the interest that you would receive in a bond ETF versus the interest you would receive in a high-interest savings account. Now, because the interest rates on a high interest savings account like EQ are so high, and EQ is, like I said, easily one of the highest ones that I've been able to find, an argument can be made to just put the safety portion of your money in a high interest savings account instead of a traditional bond ETF. Of course, I suggest that you keep your entire emergency fund in a high interest savings account anyway. You should be doing that regardless. That part's a no-brainer, as you want that money safe and available if something unexpected happens in your life. But the dilemma that we're talking about here specifically is more centered around saving for retirement, or if you are already in retirement. So in other words, where do you put your safety money that's not going to fluctuate wildly with the stock market? You definitely want a portion of your portfolio in that sort of a bucket, right? So, how much do you put in? Where do you put in? That's the big question that you get. So let's look at the pros and cons between using a high interest savings account versus a bond ETF. So the main disadvantage of using a high interest savings account versus a bond ETF is that if interest rates drop in the future, you will miss out on some capital appreciation. So bonds have an inverse relationship with interest rates. So when interest rates drop, the value of your bonds go up. So you get a gain. But it works the other way too. So if the interest rate goes up, which a lot of people believe they will because we're still at historical lows right now, then your bonds will actually drop in value. So you're still getting that yield, which will cushion that decline a bit, but the bonds that you are holding will now be worth less. So now I'm definitely not going to speculate on where interest rates are heading, but the bottom line, and by the way, as a side note, anyone that tells you they can reliably, consistently predict interest rates is full of it. No one really can. So I'm not going to speculate on where interest rates are heading, but the bottom line is that if interest rates go up in the future, you can expect to take a hit in what your bonds are worth, okay? So the question you want to ask yourself is, do you want to expose yourself to interest rate fluctuations like this for the safety portion of your investment portfolio? Now, if the answer that you give yourself is yes, then who knows, you might get lucky and interest rates go down after you buy that bond ETF and you'll get some nice capital appreciation. I mean, it's not going to be some home run because we're still talking bonds, right? So it's not like you're going to double your value. I mean, it's going to be a minor increase, but an increase nonetheless. In this case, it's great that you picked that bond ETF instead of using a high interest savings account because you just got lucky with your timing. Interest rate just happened to work in your favor and great. But if interest rates go up in the future, then it's likely that you would be better off using a high interest savings account that has a comparable yield, as your high interest savings account is guaranteed and it never drops in value. Whereas in this scenario, if you instead pick bonds, your bonds would have dropped in value. So definitely, in those scenarios, the high interest savings account would be better off. So this is a personal decision of whether you want to take on that interest rate risk or not. As you can see, it can work for you or against you, depending on what depending on what happens. And it's basically you can't control the interest rate, so it's something that's totally beyond your control. So the way that I personally tackle this dilemma is I start by asking myself, what is the purpose of the safety portion of my investment portfolio? In other words, am I trying to maximize safety and stability in the safety portion of my portfolio? Or am I trying to optimize for growth, specifically in this safe portion of my portfolio? And I'll give you a hint as to my answer. The answer is right in the question. So since here we're talking about the safety portion of my portfolio, then obviously my priority here is safety, right? Therefore, while I still want large growth, and I still, that's what the stock portion of the portfolio is for, is to give you that growth by investing in stocks, through low-cost index ETFs like what I do. So for example, let's say you're targeting a portfolio of 90% stocks and 10% fixed income. So for that 10% fixed income portion of my portfolio, I want that to be optimized for safety and stability. And I want that 90% to be optimized for growth. Now, this is just a sample asset allocation, that I would feel comfortable with. Once again, I'm not saying you should have that as well. That it's a personal preference piece, but this is just the way, something to think about for yourself. So this is why when we were in pre-retirement, we were actually 100% in stocks through broad market index ETFs. So the same, stuff that I've been preaching here forever. But once we got into retirement, and even a little bit before, just to help with the transition, I started building up a cushion, which was that safety portion of our portfolio. So this way, if the markets did take a major hit, I would still have that guaranteed money there, which hasn't lost any money. It's still paying me interest, and I can use that for our living expenses until the stock market recovers. So I liked it. I felt better with having that because I like not having to worry about where interest rates are going and knowing that I am going to take a hit if interest rates go up. So for that safety portion of the portfolio, I decided to keep it ultra safe in a high interest savings account that's guaranteed. So for me personally, I decided to keep that money in my EQ high interest savings account instead of buying bond ETFs. And so the main reasons for this was, one, it gives me the guaranteed rate of return. Two, I don't have to worry about the value of my safety portion of the portfolio dropping when I need it most. Three, it's very liquid, meaning I can withdraw it at any time with no restrictions. Now, mind you, a bond ETF is liquid too, but this is more of a reason why I chose a high interest savings account instead of a GIC for that safety portion of my portfolio, because with a GIC, your money is locked in, and so you can't take it out before the specified time, which could be anywhere from 1 to 5 years, depending on what GIC you pick. There's some shorter ones as well, but basically your money is locked in for the time that you chose, so you usually get a higher interest rate the longer you go, but that money is locked in. You can't take it out. So I do like GICs too, mind you, but because this was our first year in full retirement, I wanted to have that money liquid so that if there was some sort of emergency in life that I didn't foresee, for example, our car actually literally ended up breaking down shortly after we retired. So, this is why, I had all, so this is why I really liked having access to all my money with no restrictions in a high interest savings account, because it's first year retirement, everything is based on sort of projections. Once you're in it, things might change, you might get emergencies, and so if you do want that money available at any time, that was a really, really good fit for us, and it really helped me sleep well at night as well, because you're not getting that those paychecks from your job anymore, right? And so to know that, okay, I've got this nice secure pot of money, I've still got a lot of growth, so I'm still keeping up with inflation, my portfolio is still doing well, but having that safety portion of my portfolio where I don't have to worry about interest rates. I know it's in there. I know it's guaranteed. I know I'm getting a secure, really high interest rate consistently. It's just that really, really helped us personally. So number 4, it's safe because it's insured by CDICs. This is another reason why I decided to do the EQ high interest savings account. It's because it's safe, because it's insured by CDIC for $100,000 per insured category. In other words, the insurance on your money is backed by the government of Canada. So that means is that even if the bank was to go bankrupt, for example, you would still receive all your money back, right? Because it's secured by the government. So, just to be super clear, I'm not saying you should sell any bonds you have and put them in a high interest savings account. I don't know your personal situation, and you should work with a qualified fee for service financial planner to determine the right mix for you when it comes to bonds, GICs, and high interest savings accounts. In other words, make sure you work with a professional that doesn't actually sell these products so that you can get a truly unbiased opinion. But I did want to get you thinking about these pros and cons so that you can better decide what's right for you. And I thought sharing with you how we approached it, so using a high interest savings account for our emergency fund throughout life, and then using it even more during retirement as a cash cushion, that was something that was a really good fit for us. So like I said before, the bank that I use for this is EQ Bank because they easily have one of the highest rates in Canada. Plus, it's totally free. Plus, you get the unlimited transactions, you get unlimited Interac e-transfers, and it's CDIC insured. So all the deposits are safe and guaranteed, like what we just talked about. So if you are going to sign up with them, please use my link as it really helps support the show. And that link is buildwealthcanada.ca/EQ. That's buildwealthcanada.ca/E Q. And to thank you for doing so, once you sign up using that link, just email me any confirmation email that you get from them to bonus@buildwealthcanada.ca, and I'll email you my in-depth guide on the top ETFs in Canada. So these are all the ETFs that I personally use in my investment portfolio. It's literally what the entire stock portion of my portfolio is invested in. And in that guide, I explain why I chose them so that you can better evaluate whether they are also a good fit for you. Now, I don't sell investments at all, so the guide is a totally unbiased opinion. And I have researched them pretty obsessively because apart from our house, our entire net worth is literally invested in these ETFs. So I think this would be I thought this would be a really valuable resource to you, as there are thousands of ETFs out there, and at least with this guide you're getting an unbiased opinion on the top ones that I found and the ones I actually use. And so I think it'll definitely help you with creating a short list of what you decide to invest in yourself. All right. So we already talked about the safety portion of my portfolio. So this guide essentially tells you what I chose for the growth portion of my portfolio to capture the growth of the markets while also paying the lowest fees possible. All right. So just to finish it off, just to recap, the process is go to buildwealthcanada.ca/EQ. That will take you to EQ's homepage. Open a free account and send me any confirmation that you receive from them to bonus@buildwealthcanada.ca, and I'll send you the full in-depth guide for free. The only caveat is that you must use that buildwealthcanada.ca/EQ link to sign up. So you can't just Google EQ Bank, sign up, and then expect the guide. So just make sure you use that link. And then that's pretty much it. So, thank you once again for supporting the show in that way. If you do, it really, really helps a lot. And now let's get back to the interview. I hope that sort of guide and how we did, I hope that was helpful to you. All right. Take care. Bye.
And I think that the whole, low interest rate, aging Canadian, high exposure to mutual fund conundrum. You put all those three things together, and you've got a lot of baby boomers that are going into retirement with a bunch of money in fixed income, bunch of that money in mutual funds. And if you're in a balanced mutual fund where you're paying a 2% fee and 30 or 40 or 50% of your money is only earning 2%, you're paying a 2% fee to earn a 2% rate of return. Half your portfolio is earning nil. You might as well put it under your mattress. So I think it's a very difficult time for investors who are invested in traditional ways in the mutual fund market to make money.
For sure. I had that. I was helping a family member out with their investments not too long ago, and yeah, they were basically very conservative. So they're just in all fixed income. And they were with a high fee mutual fund, or it was a segregated fund in this case. But so I mean, the MER was like over 2.5%.
Oh, I'm sure.
Right.
Yeah.
So I think it was like so over 2.5% fee. And so you look at their statements, and it's like, oh, I earned 1% over the. They're like they're wondering, Cornell, why aren't I earning any money on this thing? And it's like, well, because the interest rates are low, and you're all fixed income, and their fee is more than what it's enormous. So yes, you're literally earning no money and just paying these fees. So obviously we fixed that for them. But I mean it was I worry about seniors, right, who are in that, this person's a senior now, in that situation where they're following the traditional advice about going more bonds as they get older, and they're still doing traditional investing via high fee mutual funds. And then, I mean, that money, it's not, if they're earning 1%, I mean, it doesn't even beat you inflation, right? So it's
and I think one of the challenges is a lot of them are being advised by people that work at, Bank ABC, and, they're mutual fund licensed financial, quote unquote, financial planner or financial advisor at the bank branch level. And all they can do is offer bank mutual funds with fees of whatever they are. They're not fiduciaries. They don't need to tell their client about other options, unfortunately. And there's a lot of people that are getting conflicted advice that, if the only thing that someone at the bank branch can do is sell you mutual funds, if you're looking for a solution to your problem, you're going to get sold a mutual fund, right. Unfortunately, whether or not that's the right way to go.
That's a good point. Yeah, I mean, their hands could be tied. If someone says, I want to go ultra conservative, I'm older, I don't feel comfortable, my risk tolerance isn't that good, what do you have for me? And they say, well, I have this fixed income, mutual funds, and that's what they have to sell, and they get in trouble if they say anything else, right? And they can't tell them, oh, well, you go for all equities because our fees are going to eat up all your returns if you go bonds. I mean, they can't do that either. So yeah, it's a tough situation to be in. Yeah, well,
and it's easy to criticize those people, and I've been known to criticize them in the past. But at the same time, you could have somebody that's doing the best job that they can do and the most genuine and looking out for the client, but the tools that they have are crummy, high fee, low yielding bond exchange traded or bond mutual funds. They're doing the best they can with bad products. It's a very difficult environment, though. The Canadian financial industry, the way that it's structured, unfortunately, is not necessarily meant for the consumer. There's a lot of great people out there, a lot of great advisors. I have the pleasure of meeting a lot of people, frankly, even at the bank branches sometimes, that you think, okay, there's one of the good ones, right? But it's a tricky industry, and buyers definitely need to beware.
For sure. And I mean, if they have a client come in and they're recommending low-cost ETFs and DIY investing that the bank makes no money off of, or negligible amounts, even if they keep it within the bank's brokerage, I mean, that advisor is going to be on the chopping block, right? I mean, they don't have they're not going to hit their quotas. They're not going to hit any of that. They're definitely not getting promoted. They have a family to provide for as well. So, I mean, it's a really tough spot. It's like being asked to do a job with really horrible tools. And then, you know what I mean? And then I assume some, encounter some ethical conflict as well, right? I know this is the right thing for the person, but this is all I can sell them, but it's wrong for them. So what do I do? Yeah.
I think the other challenge with DIY investing and exchange traded funds, and I think it's great the way the market has developed, and I think that there are some great opportunities through discount brokerages and some of the 800 or 900 exchange traded fund options that you have to do some good self-directed investing. But I meet a heck of a lot of people who will never be DIY investors, and I also meet a lot who have an interest in DIY investing, but once you start talking to them, you realize there's no way, you're not well equipped for it. Some people, despite their best interests or despite their best intentions to be a DIY investor, actually sitting down and pressing the buy and sell button is tough. And I have people that I've seen go DIY and have got to a point where they've said, you know what, I just don't feel comfortable anymore. I don't really monitor my portfolio, or I don't know when to sell, or I don't know what to do, who've actually gone back to the traditional investment industry. And that's a matter of finding the right person that's a right fit. So there's, despite the ability to be a DIY investor these days, some people are frankly never going to be a good fit, unfortunately.
Mm-hmm. Oh, for sure. And I mean, that's a really good segue into sort of my next line of questions here about the asset allocation ETFs, because I do find that many investors who are new to investing or are switching to do-it-yourself investing, so maybe they've been with a mutual fund for years, they learn about these fees now, they're ready to switch, they want to do it, but sometimes they get intimidated by now having to, for example, rebalance their investments and actually go, and there's also the piece some people get intimidated about just going on, kind of the open market, right, and actually executing the order, that kind of thing.
Oh yeah.
But I think that can be overcome if you see how someone does it. But I think the rebalancing thing, from what I gather, is what hangs a lot of people up. Not everyone is a spreadsheet nerd like myself, and I imagine you're a spreadsheet guy yourself as well. So yeah. So I mean, what are your thoughts about the asset allocation ETFs? And maybe if you could define them first as well, just for anybody that's not familiar, because they seem like a good. I mean, I like them as like a middle ground, between, okay, you want to get away from those high fee mutual funds where, yes, your hand is held, but you pay very, very dearly for it, versus asset allocations, which is kind of much, much nicer in my opinion, versus going the full blown, DIY ETF, where you're picking individual ETFs for strategically picking them for different accounts, to make it more tax efficient. Not everyone's willing to jump to that level right off the bat. So I find asset allocations are kind of that middle ground and a good transition point for many. What are your thoughts on those?
Yeah, so traditional exchange traded funds are investments that you buy that trade on the stock exchange that historically have tracked the Toronto Stock Exchange or the S&P 500. So if you bought an equity ETF that tracked the Toronto Stock Exchange, you would have an investment that would go up and down as the TSX went up and down. If you wanted to build a diversified portfolio, which everyone should have exposure to Canadian stocks and U.S. stocks, international stocks and bonds in whatever proportions are appropriate, you'd have to go out and buy, generally at least 3 or 4 or 5 different exchange traded funds to get your asset allocation done properly. Some would argue it's more than that, but generally at least a few different exchange traded funds. And then you're trying to decide, how much do I put in the Canadian ETF? How much do I put in the US? How much do I put in the international or the bond ETF? When do I sell? When do I buy? These asset allocation ETFs are kind of cool. They've been around in Canada. Over the last year, there's been a number that have become available. And with an asset allocation ETF, in theory, you can buy a single exchange traded fund that gives you exposure to Canadian, US, international stocks and bonds. In some cases, it's Canadian bonds, US bonds, international bonds, very diversified. But a single exchange traded fund, you can have your entire portfolio and just buy one exchange traded fund and not have to worry about rebalancing, not have to worry about doing anything because the rebalancing is done for you as markets ebb and flow. The ETF internally rebalances back to some predetermined targets. So it's a great way, I think, for someone who is convinced they want to go DIY to go or potentially consider. I think it's going to be really interesting to see how things progress, because in my mind, it's a competitor for the robo-advisors that, build ETF portfolios of 7 to 10 exchange traded funds for investors and charge a fee of, 0.3 or 0.4 or 0.5% of your assets to do it. An asset allocation ETF, I think can provide a DIY investor a real easy way to do it. And my own bias for a DIY investor is, rather than trying to build a portfolio of stocks and bonds, I think most DIY investors are better off just going the ETF route because it's simpler. And the DIY investors that I've seen really blow things up are the ones that go and try to build their own stock portfolio and just buy a bunch of banks or start getting fancy and buying, penny stocks and trying to be day traders. ETFs can be a really easy way for a DIY investor to go at it themselves.
Mm-hmm, for sure. Yeah, I found just talking to listeners of this show too. I mean, I talk to quite a few and get emails all the time. And, I find that there are some that say, okay, I get it. I shouldn't be in these high fee mutual funds. There's better options out there. And then I have a course too where I show how to do kind of what we talked about before about actually picking individual ETFs strategically for the right accounts so that you get that tax optimization and all that. But I noticed just by talking with others that some are okay going to that, but some will say, okay, this is like
too much.
This is a little too much all at once.
Yeah.
I don't feel comfortable, rebalancing myself using a spreadsheet, that kind of a thing. But so should I just go for a robo-advisor then, right? And then I say, and then kind of learn what you're showing and, learn how to optimize it, over time. But in the beginning, just to get out of these high fee mutual funds, should I just go with a robo-advisor? And then I say, well, why don't you consider the asset allocation ETFs? Because you're going to be paying much, much, much lower fees. And you're still, and then also you're getting a kind of a step in as well into, you still have to buy them on the market through your brokerage, right? So you sort of get that experience, you learn how to do it, but it's so much easier because you're just buying one ETF. So if you've ever bought a stock, it's the same thing, the same process basically, right? Yeah. You're just buying one thing. And I find that is such a great way for people to ease into it. And
I would agree.
Yeah, because I can see how it gets overwhelming. Where okay, hold on, there's 4 ETFs, I got to buy 5, and which accounts do I put them in? And I'm
adding money or I'm taking money out. Where do I take it from?
That's
how
right.
much?
That's right. And then I have to rebalance now, but I don't have the same amount in each account.
I don't want to pay the $40 in fees to do rebalancing.
Exactly. So how do you do that? So there's all these. So it's kind of like not everyone is at that like 201 level, right? Sometimes it's like, let's start with the 101.
Yeah, start with 101. I agree.
Yeah.
I don't think it's a bad approach at all. You don't necessarily need to go out of your way to have optimum tax efficiency as a DIY investor. It's definitely a step into the DIY market for those who are well suited for it. Mm-hmm. But again, it's amazing, Cornell. I'll tell you how many people that I talk to that have an interest in DIY investing, and my goal is not to turn people into DIY investors or to direct them to any sort of other way of investing. I sell my time. I don't get referral fees or commissions. I don't sell investments, but I have clients who've been thinking about going DIY, and I'll end up instead suggesting they consider a robo-advisor, or instead consider that they speak to a certain type of investment advisor or portfolio manager, or whatever the case may be. Everyone's a bit different. Everyone's at different ages and stages. And some people like to have that traditional advisor relationship. So I try not to let my own biases come through and let people choose the right course for them.
Mm-hmm. And are there any negatives about asset allocation ETFs that you think Canadians should be well aware of and consider before deciding to maybe consider these types of investments?
I think tax efficiency, I suppose. Mm-hmm. And, ideally, if you've got different types of accounts, you've got an RSP, a TFSA, non-registered corporate, RESP, there can be advantages to holding certain types of asset classes like fixed income or Canadian equities, for example, in certain types of accounts. But as you alluded to me, that's sort of 201 and DIY 101 is just, building a simple diversified portfolio. Asset allocation ETFs do it. I think some people might look at an asset allocation ETF and say, this is too simple, one investment. It's not that diversified, even though it's got like 10,000 underlying holdings, or whatever it is. Like, it's more diversified than, the vast majority of portfolios that I see. I suppose there is that risk that people see it as being too simple. and trying to complicate things. But the list of drawbacks, I think, is low relative to the potential benefits. I suppose one of the other ones is that generally the way that it works is you can buy an asset allocation ETF that's got 20% exposure to stocks and 80% to bonds, or 40-60 or 60-40 or 80-20 and so on. So you can have a 20% difference in risky asset or stock allocation between one exchange traded fund and the other. That may be a big jump to increase 20% stock exposure and have 20% more downside risk in a downturn. I mean, that can be mitigated by holding multiple exchange traded funds. Like if somebody was trying to decide between an asset allocation ETF that had 60% in stocks and one that had 40% in stocks, and they weren't sure which one, they could put half in one, half in the other, right. And then the combination of the two of them would end up being 50%.
That's right. You can blend them.
Stocks.
Yeah.
So there's ways to mitigate that risk. Not having it's not really a negative of asset allocation ETFs. It's a negative of DIY investing, not having somebody to be able to call when stocks are down and the sky is falling and it's, the end of the world, which will happen at some point in the next few years. And we will see a recession and a bear market one way or the other. As long as a DIY investor, particularly those who've been investing over the last 10 years when markets have performed actually reasonably well, I think that that's another important risk to remember. Stocks will fall. You will lose money being in stocks. But as long as your time horizon is long enough, you will recover and make that money back. Mm-hmm.
That's a good point. Yeah, I mean, the tax efficiency piece you mentioned, that's pretty much the primary reason why I don't use the asset allocation ETFs myself, just because you can squeeze quite a bit in terms of tax efficiency, whether it's the withholding taxes, things of that nature too, just by buying the individual ETFs. But I totally get it how it is. Not everyone wants to jump to that level right away, and it's like you want to get your feet a bit wet first, and so asset allocations are a good option for that for sure. Just to give anybody, if someone's really new to this and maybe are confused by the asset allocation ETFs, the process is essentially you figure out what your asset, and Jason alluded to this in his answer, you first find out what you want your asset allocation to be. So let's say it's 80% stocks, 20% bonds, and then the different asset allocation ETFs, they have different sort of proportions. So one of them will be 80% stocks, 20 bonds, and so then you just buy that one and you will add that asset allocation. So you just keep buying the same one. So step one is figure out what the asset allocation you want, which is what we were talking about before, where you can do the different quizzes, things like that. And I will link in the show notes as well, put on the site some good free questionnaires that you can use. And then once you know that, then you can say, okay, I know what my allocation is. Now I'm going to buy, this particular asset allocation ETF. But yeah, if anybody listening has questions about it, let me know, because I am building a really big guide on it because I get so many questions about these. So I'll make sure to include your answer in that and just to help everyone out. So Jason, what accounts would you say are these asset allocation ETFs best suited for? Are there some accounts that they're better for than others?
Yeah, I'd say there's not necessarily an ideal location, but people need to keep in mind the benefits of different asset allocations and different accounts. If somebody has a single account like an RESP, for example, that is meant for a specific purpose, like you probably want to have an RESP with a diversified portfolio within just that single account. An asset allocation ETF could work well for an account like that. Or if the only account somebody had was their RSP, that could work well. It's just when you have multiple accounts that there could be benefits to going beyond asset allocation ETFs into individual ETFs. But again, the incremental benefit of the tax efficiency may not be huge for some people. Mm-hmm.
Yeah, one of the ones that I've been kind of trying to figure out is we have an RESP for our kids, mm-hmm. and I just bought ETFs within those the way we normally buy, where I buy the individual ones. And this was before like the asset allocation ETFs even existed, I think, is when I started it. But now I'm thinking, man, these things are really convenient, because for the RESP, I can just buy one and be done with it. And there isn't this sort of tax efficiency that you get RESPs that you get with other accounts, like if you do like a RRSP, right? There's some arguments to be made why you wouldn't want to do, let's say, an asset allocation ETF for that. But what are your thoughts about that? Because it seems I'm getting tempted by the convenience, and the MER is slightly higher, but it's not that much, and it's not like you have hundreds of thousands of dollars in your RESP either, right? So even the higher MER on an absolute basis, the fee seems somewhat negligible. What are your thoughts?
Particularly if you would otherwise, be holding 4 or 5 different ETFs, and you would need to rebalance and incur commissions, or if you were adding money on a regular basis, and you would be buying, paying 5 commissions to buy rather than just 1 to buy the asset allocation. Yeah, I think a single account type like an RESP, it can work really well for a DIY investor. And particularly even a DIY investor, frankly, that is building their own portfolio of individual stocks and is rather sophisticated, they may well use an asset allocation ETF for an RESP account and focus their attention and their trading activities on another account. So it can be a way to have some of your money kind of hands off and simple and low maintenance, and focus your investing attention on the accounts where it may matter more.
That makes sense. Yeah. Because the way I look at the RESPs, I mean, this is very separate from a retirement, like the TFSA, the RRSP, non-registered account. I mean, those I've earmarked for retirement purposes, right? But the RESP for the education, it's a different animal, right? It's like its own little bucket, the way I view it. Like it's still part of your net worth. So if things go really bad and you all lose your jobs and we desperately need the money, yeah, okay, fine, maybe you can still you can still draw on that. But really, I mean, if things go according to plan, that's its own little sort of bucket that you manage. At least that's what I do, is I manage it sort of very independently. Sorry, you said you agree?
I would agree, absolutely.
Yeah, and so that's why I'm thinking, well, just do the asset allocation.
It's a little portfolio that's kind of almost separate from your own investment.
That's right. Yeah. So that's why that has so much appeal, I think, as well. So no, that's good to hear that you feel the same way. That's great. Speaking of rebalancing, if somebody doesn't want to do that asset allocation approach and does want to rebalance themselves just to squeeze that extra tax efficiency out in their regular portfolio, like their retirement portfolio, do you have any sort of rules that you like in terms of when you rebalance, both for yourself, for your clients, etc.?
Good question. I, from experience, from working with DIY clients over the years, I can say that the majority of them do not pay that close attention to their portfolios in terms of rebalancing and buying and selling and trading. I mean, I certainly do have clients. I can think of one client where it's in retirement. It's their full-time job. They're monitoring their portfolio, looking at it every day, and to each their own. But a lot of people I find leave their portfolio alone for most of the year when they're DIY. So for most people, I think at least a couple of times a year. A couple for some might be quarterly. For others, it might be semi-annually. I think at least once a year, you should certainly be looking at your portfolio and rebalancing. I think much more than quarterly. And you're looking at your portfolio and tinkering too much, unless the caveat that is an exception to the calendar rule would be if there was a big movement in the markets. And what is big? What percentage movement? Again, I don't think there's a percentage that I could or would suggest. I know that some of the robo-advisors have their own rules about when they rebalance, but if there's a big movement in the markets and you've heard about it, that stocks are way up or stocks are way down or a particular market, that may be one reason to look at your portfolio in between your quarterly or semi-annual or annual check-in. But I think for most people, just setting a reminder in their calendar should be sufficient.
Mm-hmm, mm-hmm. Yeah, what I found is when we were doing a lot of investing, building up to the retirement, we just with every paycheck, I have a spreadsheet, right?
Yeah.
And I just have
you're adding or subtracting, that's a great time to just do a little check-in, or in some cases you might be putting all the money into Canadian equities or US equities or bonds, depending on how the portfolio is ebbed or flowed.
Exactly. Yeah. So that way I remember that whole sort of journey, and I never had to really sell anything to rebalance because with every paycheck, you just say, okay, I'm going to buy the correct proportion of each amount to get the portfolio back into balance. And then I have a spreadsheet that I use, and it's in the course I mentioned as well, where you just you plug the numbers in, and it's like, okay, I have to buy this many units of this many units of that based on the asset allocation that I specify, that you specify that you want to have. And I found that was great, right? Because I'm with Questrade as well, where you can buy the ETFs for free.
Oh, yeah.
So it's like I'm not buying anything to buy them. I'm not selling anything because you do pay when you sell, but you're not selling anything because you're just rebalancing by putting a portion of your paycheck in. And that worked out.
That's great.
But I hear you. Like, you definitely still want to go back. If there's a big market move, you may want to take a look and also
I think just for rebalancing purposes alone, I try again going back to our market timing discussion. Markets move. That just means it's a time to rebalance, not to panic or not to tinker.
Yeah. That's right. Sell everything and put in the gold or Bitcoin. All right.
I get those questions once in a while, and I'm not investment licensed, so I'm not registered to recommend particular securities. I can talk high level about strategy and tax efficiency and things like that, which frankly I think is more important than whether you're in Royal Bank or TD Bank. But I get those questions every once in a while, and I just, I think it's hard for a DOI investor. It's hard for a professional investor to, build and manage and actively manage a portfolio. So for DIY investors, I really lean more towards ETFs. Keep it simple.
For sure. Now, for this next question, I think we've covered it a fair bit, but I'm going to ask it anyway, just in case there's anything that you want to add. But basically, it was that for somebody that is already retired and needs to use their investments for living expenses, how do you determine whether to sell off equities versus sell off bonds, or use cash or GICs? Maybe they have like a 1-year cash cushion or something like that. Do you have some sort of rule process that, okay, if X happens in the markets, that I'm selling off equities to generate cash to live from, and if Y happens, then I use the cash cushion or the bond portion? Do you do anything like that, or is it just here's the asset allocation, here's how much we're off, and so we're going to take that money out and then we just rebalance and that's it? Is that pretty much how you do it?
My own bias is towards doing the latter. Doing just looking at the overall portfolio, withdrawing proportionately from the portfolio. Again, it's possibly more important determining which account it's coming from and when. That is my own bias, because it sort of forces the best buy low, sell high discipline, and always keeps your portfolio in proportion. And again, there's been studies that have compared that type of approach to a bucket strategy that have showed that it may be more effective. So that's my inclination. I don't feel that I'm, certainly myself, I don't feel like I'm smart enough to know whether markets are going to go up or down tomorrow or in the next year or in the next 3 years. Certainly over the next 5 years, I expect diversified, balanced international portfolio to be up 5 years from now. But in the short run, I think it's just too hard to tell. So I bias away from bucketing, but some people, it gives them the emotional and psychological benefits that makes them feel better and sleep better at night. And that's super important in retirement. And a crazy thing that I've noticed over the years is you can be 30, 40, 50, 60, doesn't matter what age you are. I have clients that I've worked with that are into their 70s and 80s who have, 80 years old and $10 million and still worried about running out of money. Oh, wow. We're still worried about, making the right choices. And one of the most important lessons I think I've learned about money is that it almost doesn't matter how much you have and how old you are. You're always going to worry about money. And if it's not worrying about running out of money, it's worrying about what you do with money. Should I be giving more to charity? Should I be giving money to my kids? Are my kids going to be okay when they inherit this money? Money is just such a weird thing that you're always going to worry. And if there's something you can do to worry less, even if it's not the best thing to do from a financial perspective, sometimes psychology and emotions need to trump mathematics.
Mm-hmm. No, that makes sense. So what you were saying, I guess we talked about this a bit before, where in the case of this, having certain rules or things like that in terms of, do I sell equities, do I sell bonds? You'll just say, okay, let's say we agreed on an 80-20, 80% stocks, 20% bonds, just as an example. Then the equation is, if I'm on 40,000 for my portfolio, how much, if I take that out, I want to take it out in such a way that once I take the money out, I am at that 80-21 asset allocation that I decided is what I want. And then part two, which is then, and from which accounts do I take that money out of so that is very tax efficient. So if you're, let's say you have a really high income earning year, then maybe it does not make sense to take out as much from the RSP because that's going to now inflate my income, etc. So you sort of play around with that either by yourself if you're a giant money nerd like myself, or you have or you have a financial planner like yourself that kind of helps with these optimizations and knows the tax rules and things like that. So did I understand that correctly in terms of your approach?
Yeah, that's correct. And I'm just trying to think of like real case scenarios that I encounter. And I can think of a client, for example, that every November we connect to talk about their portfolio and their income taxes for the year. They've got a traditional transactional investment advisor, a stockbroker effectively that they work with, and they've got non-registered money and they've got RSPs. And depending on the capital gains that they have had in their non-registered portfolio over the course of the year, we may or may not take an RSP withdrawal. They're in their 60s. They've not converted their RSPs to RIFs quite yet. But some years we don't take any RSP withdrawals because they've got a lot of capital gains and they've got a lot of non-registered investment income, whereas other years there's none, and we sneak some money out from their RSPs at a decent tax rate. And then we're trying to rejig and rebalance the portfolio accordingly. So depending how you invest your money, it may impact where you take the withdrawals from year to year. It may impact whether you're taking it from stocks or bonds. And then I think it's trying to then rebalance the portfolio thereafter in some cases. So, I wish there was a simpler way to explain it to your listeners and say, here's what you do and here's the strategy and here's the approach. But I find that in real life sometimes it depends.
For sure, you pretty much have to do it at the high level just for overall sort of strategy and what you're aiming for, just to see the goalposts, and aim toward. But then everyone's situation is so different. Like, do you have side income? Do you have pension income? Are you doing this investing on the side, like in your example, in a non-registered account? And that's going to determine how much money you make. And so maybe you don't take out anything from RRSPs because, you're going to be taxed at a higher tax rate if you do. So it gets into this whole tax strategy, tax planning piece together with the financial planning. Yeah, it's very...
That's a really important factor, I think, once someone has moved into the retirement phase. And it's just emphasized more so if they have different potential sources of retirement income, investment accounts, pensions. When do you time your pensions? It's kind of cool trying to figure out the right way to fund retirement, but it's tough, particularly for a DIY investor. The accumulation phase can be super easy. You can just buy an asset allocation ETF and just throw your money in there and never have to worry about rebalancing at the extreme end. But I think regardless of who you are and how you invest and whether or not you have an investment advisor, once you move into the decumulation phase, which has not been paid attention to very much until recent years, now that we have all these baby boomers retiring, it gets tricky. There's tax and other implications as well.
For sure. Yeah. I mean, we kind of did a full retirement about 6 months ago now. And I've definitely found the decumulation phase so much more complicated than the accumulation phase feels easy compared to the decumulation because there's so many things and so many unknown variables and different approaches and different models. And if you mess it up, you run out of money. So the stakes are very, very high, right? If you mess it up. So no, I hear you. It's very interesting once you start going kind of down that path. But it's kind of nice too because you have so much flexibility in terms of tax optimization. Whereas when you're earning money, or like a regular job, it's harder, I find, right? Because you have if you have a regular traditional job.
If you're a salaried employee and you had a pension and you can't contribute to your RSP or you only have a limited amount of RSP.
I mean, RSP is like the primary tool you can play with, right? Whereas once you have the retirement piece, it's like, okay, now we can manage all these different income streams and all these different things. So at least it makes it a fun puzzle.
Sure.
But I can see it being extremely stressful for some people too, who aren't, reading about this stuff for fun because it's just so many.
Particularly for DIY investors, right? clients who've been excellent, well-versed DIY investors during their 50s and 60s, and you get into your 70s, and sometimes it can be difficult. I have clients who've said, I'm having a harder time managing my portfolio, but I don't want to pass it over to an advisor,
Right.
and maybe in a couple of years. And I've had conversations with people who've said, in a few years, I want to choose a portfolio manager. I want to choose an investment advisor. I'm not quite there yet, but it can be a lot easier to manage your investments and make financial decisions when you're young. The degree to which it becomes difficult to use that part of your brain, even if cognitively you don't have any impairment, there can be a lot of changes that happen in your 60s and 70s and,
For sure.
and 80s. It's going to be a very interesting conundrum, I think, for the financial industry and for regulators and everyone over the next 20 years.
No, definitely. And just to finish things off and maybe change subjects a bit, what are your thoughts on the 4% rule? And are there any variable spending strategies that you like instead of using the 4% rule?
The 4% rule, I think it's kind of cool because it's a rule that has some sort of basis to it that people can use and apply to their own investment portfolio and portfolio withdrawals. There are some problems with the 4% rule, specifically in that when it was put forth back in 1992, I believe, the calculations did not factor in any investment fees, which for some DIY investors, there aren't, or there's very little investment fees. But for the vast majority of investors, fees are relevant and pertinent and may cause the 4% rule to be lower than 4%. And just to make sure that all the listeners are aware, 4% rule just suggests that for a 65-year-old that is retiring and is planning for a 30-year runway for their investment portfolio, that they can withdraw 4% in the first year and then index that dollar value to inflation and increase it every year thereafter. And the likelihood of running out of money during a 30-year retirement is quite low, even in the worst historic 30-year period for stock market performance. There was a great paper that was done in the last year or two by David Blanchett at Morningstar, and they looked at the 4% rule for Canadian investors and put forth that 3 to 3.5% may be a better rule for Canadians, taking into account not only potential investment fees, but also just that in 1992 interest rates were a heck of a lot higher than they are now. And 3 to 3.5% may be more appropriate. But there's tons of fine tuning required. I find with those rules, there's a big difference if somebody has all their money in an RSP versus in a TFSA, for example, because there's tax implications obviously on RSP withdrawals. Some people are expecting inheritances or a home downsize or, still going into retirement with debt, and rules are linear, but life is variable. So while I like the theory behind the 4% or 3% rule, I think even variable spending strategies, that you referred to, there's a number of them that give people rules for when and how they might change their spending in retirement based on portfolio performance. So that if your portfolio does poorly, that you may have some part of your spending that's variable, that you spend less in the subsequent year. It's cool stuff for money nerds like you and I, but I think it's theoretical. In real life, I find that rules like that are really tough to implement. I'm biased. I mean, I spend a lot of my day building out these long-term retirement and financial models for people to try to help them determine how much they need to save, how much they can afford to spend in retirement. And some people, there's changes that happen from year to year: death, disability, job loss, inheritances, good things, bad things that need to get taken into account. So I like the theory behind variable spending strategies and 4% rule, but life doesn't always work that way, unfortunately.
So you just do it on like a year by year basis, it sounds like, and you just...
Yeah, even year by year. I mean, I'd love to say that you should do it on a year by year basis. You know, I have clients that I work with year in, year out, and I have for 15 or more years. Then I have other clients where it's every 5 years. Then I have other people that I meet once and never see again. I think whether you're working with a professional or doing it on your own, the frequency is going to change depending. But I think, forcing yourself at least once a year, even if it's on your own, to sit down and make some money decisions makes sense. But life, no, I can tell you one of the challenges that I've come across recently myself, I spend most of my day trying to help people live to 100 and not run out of money. But personally and professionally, I don't know what's in the water the last couple of years, but I have a couple of people in my life, unfortunately, that have died at a young age, clients and family members. And it's caused me to sort of take a step back and say, gosh, am I telling people to be too financially responsible and save too much when, you never know what the future holds. You never know if you're going to live to be 95. Should you be living more for today rather than saving for tomorrow? And I think that's the problem with rules. Life is very fluid, for sure.
So when you're meeting with a client and they say, okay, here I've got, let's say, $1 million, I want to know if this is going to last me for the rest of my life, whether it's an early retiree, someone in the FIRE movement, let's say, or even just a traditional retiree. I assume you have your financial planning software, so I imagine you run the simulations in that, but then do you do like Monte Carlo analysis on top of that to see if it's kind of sustainable? How do you sort of, I guess, stress test these things just so that when you say, okay, you want $40K a year, yes, you can do it, but what are sort of the checks and balances that you go through yourself so that you can confidently tell the client, yes, you can, or you know what, maybe we're still gonna, tweak it accordingly annually, but as a baseline, here's what I would feel comfortable telling you to spend this year.
Yeah, I mean, sometimes we will do Monte Carlo analysis, which is very, it's, part of the analysis that goes into the 4% rule. And it's really cool, again, for us money nerds. I find sometimes it's difficult for lay people to get their heads around. Sometimes we'll look at linear rate of return scenarios, but we'll stress test at a lower rate of return and a higher rate of return just to try to do it in a simple way that clients can understand. One of the challenges that I find with Monte Carlo analysis is that you're basically taking a whole bunch of different historic rate of return scenarios that look at low returns and high returns for an investment portfolio and applying it to your plan over a 30 or a 40 or however many year retirement. But again, you sit down with somebody and say, you can afford to spend this much, even in the lowest rate of return or worst possible sequence of return scenario, but it does not factor in the potential of a job loss, an inheritance, death at a young age. Like, you can't run Monte Carlo analysis on your life expectancy or on your chance of becoming divorced. Like, there's so many factors beyond sequence of returns that happen in real life that I think Monte Carlo can be an important tool. But I think it really reinforces for me that retirement planning and financial planning generally at any age and stage is not something that you can do once and just say, I'm cool, I can spend this much money for the rest of my life, or, I can save this much and I'm going to hit my targets. It's something you need to come back to occasionally, not necessarily every year, not necessarily even with a professional, but, it requires constant revisiting. For
sure. Yeah, I mean, I know what I do personally for our own finances. So I use Snap Projections. That's the software that I use. That's you've heard of them, I assume, or?
Yeah. Good software and tough. I had somebody ask me today about a good software tool to use just for them to run their own retirement calculations that was like a retail software.
Right.
And I mean, Snap is one that maybe somebody could learn how to use. But
I know for sure it's only for financial planners though. So
not really meant for your listeners. And that's what I said. I wish I could give you a good recommendation, but
But
there's a handful of commercial softwares in the market, and they all take a little bit of time to learn how to use.
Yeah. But yeah, like what I was getting with the snap projections pieces, and from what I've looked at other softwares as well, and they seem to be similar in the sense that they'll do that sort of like what you said, the linear return, where it's like, okay, we're going to assume your portfolio is going to make, let's say, 6% a year or whatever the case is, depending on your asset allocation. And it kind of does that as, every year we're assuming you're making this much. So I find, that from the softwares I've seen, that's a common thing. And that's great planning can be done around that. But then I don't feel like that doesn't really cover the sequence of returns piece very well, right? And so that's why I was thinking, at least for my own finances, when I was crunching the numbers for myself, I said, okay, I do all this like different scenarios and snap projections just to, because you can really factor in a lot of things in there that you can do through like a regular online calculator that does Monte Carlo, but then also use Monte Carlo in addition to that to say, okay, let's sort of run this scenario to see in a worst case scenario, would I still be okay? So I kind of like did both of them, like used both tools, a Monte Carlo tool and a financial planning tool. And then if both of them are saying yes, then to my plan, then that means I'm good to go. I mean, what do you think of that approach?
I think it's a good approach, but my biggest knock on Monte Carlo is just that it focuses on an important, albeit not the only important piece of life and retirement. I can't help but worry that the risk of working too long or the risk of spending too little and dying with too much money is also a risk. I'd rather die young with lots of money than die old with none and live a pauper in my later years. But there's risks on both sides, and there's not really a way to mathematically look at those risks or look at the risk. I have a client right now going through a divorce late in life in their 60s, and boy, I mean, it changes things for them, and no Monte Carlo analysis in the world look at that type of scenario. So again, Monte Carlo, helpful. Does it take into account all the potential things that could happen in the near future? No way. There's a lot of different variables when it comes to retirement planning. And if we could see into a crystal ball, it would make financial planning so much easier. Right. But I think I like life the way it is, where it's a little bit more variable and fun and interesting, and you don't know what lies around the corner.
Mm-hmm. That's very, very interesting. Yeah. Okay, that's great. So second last question, if you could go back to when you first started investing, what advice would you give yourself?
It's a good question. When I think back to my first real foray into investing, I remember buying a precious metals mutual fund. And I remember making a little bit of money and then losing a bunch of money and never making it back. And I don't remember why I bought it. I think at the time I put all my savings into it. It was a, not at all diversified portfolio. I think I must have read an article in the paper or something like that. And, thinking back, that was me being dumb. And I had some insight. I studied economics at university. I was doing my CFP designation. I should have known better, I suppose. But I think it just goes to show you need to beware the financial media that I'm a part of, because there are people out there that are not financial planners and are not CFPs or CFAs or accountants. And even those who are may have their own self-interest or bias. So I think that the mistake that I made was I was investing for the short run and investing based on a hot tip or idea. And I think that people need to really think for the long run with financial decisions they're making, and try to take any advice you get with a grain of salt.
For sure. I think a lot of people, at least ones that I've grown up with, they hear that hot tip when they're in high school or something like that, and they try it, right? And then they get, I've yet to meet one that didn't get burned. and then after that, it's like, okay, hopefully they don't swear off investing entirely. Right? But hopefully eventually they say, okay, there's got to be another way of doing this than basically being a stock picker or a day trader or something like that. And then, find that there are other approaches, and that it's not, necessarily a risky business. There's just different ways you can structure it to really decrease your risk. That's great. Thank you for sharing that. So Jason, just to finish things off, can you tell us a bit about your practice and where we can learn more from you?
Yeah, definitely. Again, I'm a fee-only or I guess advice-only financial planner. So I don't sell investments, don't sell insurance. I sell my time, my advice. We don't receive commissions or referral fees. We're an independent firm. I've got 3 other financial planners on my team, which is great. We're super busy these days, and seems to be more and more interest from people to work with financial planners in a different type of way that isn't tied to products. We work with clients in the Greater Toronto area where our office is located, but I would say these days probably at least a third of our clients are not even in Ontario. They're in other provinces, other parts of Ontario, but certainly other provinces across Canada. We work with a lot of clients in other countries, in fact, Canadian citizens who are living and working abroad. We can be found online, objectivefinancialpartners.com. You can hit me up on Twitter at Jason Heath CFP, and I also write for the Financial Post, MoneySense, Retire Happy, and Canadian Money Saver. So you'll probably see me out there as well. And just really appreciate the opportunity to chat with you today, Cornell.
It's been a blast. I love geeking out like this with with fellow people that are also really, really into this. So thanks so much for coming on. I had a blast. It was a great conversation. Thanks for your insights and your wisdom on all this. And definitely we'll I'll link out to to your site as well and all of that, and some of the articles you've written as well. It's you've definitely done some really, really great work. I've been following you for a long time. Just with all your articles you've written on MoneySense, and especially so thanks for coming on and sharing your expertise with us.
No, my pleasure.
All right,
thanks
take
for
care,
having
Jason.
me.
Bye. All right, thanks for tuning in. Don't forget to get your free tickets to the Canadian Financial Summit by going to buildwealthcanada.ca/conference. And even if you're listening to this episode months or years after it's been published, you can still go to that link so that I can let you know when I have free tickets available for next year's conference. And I'll also email you a video recording of my talk from this year's conference so that you don't miss out on that. All right. So that link again is for the free tickets, and the video is buildwealthcanada.ca/conference. All right. Hope to see you there. I've already talked about EQ Bank twice this podcast, so I'm not going to do it again. I don't want to drive you crazy. Just know that the link is buildwealthcanada.ca/EQ. For everybody that has already signed up, I do appreciate that, and I do hope you like the guide as well. I put a ton of work and research into it. And if you have any feedback, or maybe you're a non-ETF investor, maybe you're doing something a bit different, maybe there's another type of guide that would work better, that you think would be more useful to you because of just the subjects you're interested in, definitely let me know. Reach out to me. You can go on the site, buildwealthcan.ca. There's lots of ways there to get in touch with me. You can let me know, and definitely want to produce more content that is relevant to you. So if there are any sort of other ideas or guests you want on or questions you want to answer, definitely feel free to submit them, and I will do my very best to incorporate them, for future episodes or future guides, etc. Now, speaking of guides, in case you missed last month's episode, I do have a new free guide that I created on the top personal finance and investing tools available to Canadians. So these are all the tools and sites that I've personally used to help us achieve financial independence so that we could quit our jobs and in our 30s. And they're also the tools and resources that I use now to optimize and manage our finances and ensure that we're paying the lowest fees while also getting solid returns on our investments. So I'm giving this guide away for free to all Build Wealth Canada listeners. All you have to do is go to buildwealthcanada.ca and enter your email at the top of that page so that I know where to send it. All right. Now, this will also add you to the Build Wealth Canada newsletter, where you'll be informed of new free guides as they get released, as well as any giveaways that I have on the show. So, it is the best way to ask questions that you want answered on future episodes of the show. And I suggest as well what future guides you'd like me to build for you and the community as well. All right. So enjoy the guide. I'm here if you have any questions, and you can get all that by just signing up for free over on the front page of buildwealthcanada.ca. So enjoy, and I hope to see you at the conference next week. Cheers.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.